Hello. One of the biggest problems that you'll have as an investor is keeping your emotions in check. The fact is that when you feel great, you feel like you're going to go and buying everything in the market. And then the market falls, you don't feel so good anymore, and then you're stuck with losses. So how do you keep the emotions out of your investment decisions? The man standing next to me is here to explain that. He's James Fu, branch manager of Phillip Securities, Investor Center in Marine Parade. So how do you keep the emotions out of your investment decisions?
Well, I think a lot of us being humans, we are always governed by emotions, basically. Well, there is a disciplined way of accumulating the shares that you want on a regular basis. We term it the regular savings plan with us at Phillip Securities. Basically, it is a hassle-free and easy investments. You get to pick what are the stocks that you want to buy on a monthly basis, and it happens every middle of the month. And you can set aside basically what are the amounts of monies that you would like to allocate.
So what would be a typical way that people do this?
Okay, basically what they normally will do is they probably have a specific stock in mind. In their opinion, these stocks could be a little expensive in their opinion. They would like to enter the market. So in this scenario, most of us would recommend the clients to accumulate the shares on a monthly basis rather than a one-time off basis. Perhaps like what the customer would have predicted, the price could have been fairly high.
Well, unfortunately, we can predict as much as we like. It doesn't necessarily turn out that way.
Yes.
So by investing on a regular basis in the middle of the month, what happens though if the market has a good rise later in the month? I mean, you miss some of those dates, don't you?
Oh, you definitely does, because on the term called dollar cost averaging, basically you will be buying some shares on a particular month on a higher price level and some months on a lower price level. On the average, you probably buy at a price that could be significantly or slightly lower than what is the market price currently. But of course, we would also understand that there may be market picks up, and then you probably miss out a certain portion of the pickup. For such clients, we will also advise them to set aside a particular sum of money. Perhaps they can do these two concurrently, buying at one level and also doing this regular savings plan.
Right. So you mentioned stock. Single stock. So can you just do it with one stock?
Yes, you can.
And what is the minimum investment then on a monthly basis?
Well, you can start off with as low as $100 basically.
Right. So you can pick a company out of presumably a list of blue chips. Not every company, right?
Yep.
And then you can say, okay, every month, mid-month, I'm going to put $100 into this particular company.
Yep.
That obviously then needs some time to run. So is this the sort of thing that you would do in the short term, or what sort of time horizon would you need?
Okay, normally we would advise the clients, in order to accumulate a certain number of shares at a particular price that he or she is comfortable with, we normally set aside a couple of years minimum, at least a time frame of 1 to 3. Yeah. Say for example, if the stock is at a double-digit price, every month if you set aside only $100, you probably get 1 or 2 shares out of the one lot of 1,000.
Right.
Yeah. So it all depends on the stocks that the clients pick.
And that brings up the other point. You mentioned lots. Shares trade on the market in lots of 1,000, except for some exceptions. What happens with a share builders plan?
Basically, on this note, we would be accumulating the shares on the client's behalf on a monthly basis, depending on the price at the market at that point in time. And once, over a period of, say 6 months or 12 months, the clients would have accumulated a certain portion of the shares. Of course, when the market's on an upward trend, you probably wouldn't have accumulated at one lot of 1,000 shares.
Right. Okay. So let's assume then that you've had this plan going for a couple of years. Let's say you've had 2 years of it. You've allocated $100 a month to 5 shares. So you've invested $500 mid-month every month for 2 years. You now have a nice portfolio there and you're making some profit on it.
Yep.
How do you then cash out? Because again, don't you need lots of thousands in order to sell?
Well, we can always sell on the client's behalf, whether through a broker or through the internet on the odd lot basis. The market does cater for that.
Right.
Yep.
And are there any other costs or pitfalls or anything else that we need to worry about?
Okay, basically, like I said, this is a very easy, hassle-free investment. What you need to take note of is probably when you sell off, you need to pay brokerage charges, which is what the markets are doing basically. And of course, when you buy, you are also be paying some brokerage charges as well as some custodian charges.
Right.
And
so there will be some management fees of some sort.
And it applies to every other shares, whether you are buying it or whether you are selling it. Yep.
Okay, one final thought. Let's say you have actually a fairly big lump sum. So it's not like you're maybe just scraping together $100 or a couple of $100 a month, but you actually have a sizable cash pile already. Would you then opt for something like a regular savings plan, or would you put all of that money into the market at the same time?
Oh, well, if you choose to put all your monies in the market at the same time, you probably do have certain expectations the market will probably go northwards. But my take is anybody's guess is as good as yours or mine. It's probably good to allocate.
Well, the market's very volatile at the moment.
Yeah. And then, like I said, I always advise my clients in this note, while you are bullish, please also take care that the markets will go the other way.
Right.
Yeah. So you probably wouldn't want to allocate the whole amount into just one lump sum investments. You probably also want to take a look at the markets in the next 6 months to 12 months. Perhaps when the market goes flat, the RSP plan is also good for you too.
All right.
Yep.
Thank you very much for coming in to talk to us about it today.
No
James Fu from Phillip Securities, one of the supporters of Singapore Investment Week. And you can find out more about that here on this website, cs.org.sg/SIW2013. Thanks for watching.